PricewaterhouseCoopers issued their biannual Banana Skins report on global and Asian banks. Listen for what are the key recommendations and findings of banks' concerns in the world and in Asia.
European banks have a shortage of liquidity. Asian banks have an excess liquidity. How will this play out, and what are some of the challenges for regulators?
Well, the impact on banks can be a number of fold with too much liquidity. It's quite difficult for bankers to manage balance sheets with a lot of liquidity, and it doesn't mean to say that it's less profitable to some extent. But the key thing is that because of the way the Asian markets are set up, they don't want too much liquidity in the local currency. And particularly if we look at it from a global perspective, then we want funds to move around the world in a relatively easy way. Too much liquidity locked in local markets doesn't really help that. And that's going to cause, if that happens in the long term, that could have big effects on the markets going forward. Of course, that's a theory, but if regulators, going back to your first part of your question, start to put essentially ring fences around the banks to mean to say that the liquidity in the country has to stay in the country, and the banks can't use their traditional methods of funding branches in other locations or other territories through inter-entity funding and that type of thing, then it's going to be very difficult for them to move around, and therefore translating into other currencies won't actually matter.
Dominic, can you tell us about asset bubbles and how they may affect banking in Asia?
Firstly, I think it's wrong to assume that asset appreciation is a bad thing. I mean, asset appreciation, which is done consistently over time, assists economies grow, and governments and regulators will look to ensure that that happens. I think the issue more is regulators learning from the past, learning how to make adjustments to regulations so that when lending is made against assets, when asset-based lending is made, then it's done in a way where we understand the past, it's done in a safe way, and essentially the financial institutions are protected better than going forward. It's another advance on risk management, particularly in the credit space. There's plenty of evidence out there to suggest you can do asset-backed lending in a safe way. Just a case of putting sensible regulation in place to ensure that the institution protects us against any potential downturn in the assets over a couple of economic cycles.
Dominic, what was the most interesting thing that came out of the Banana Skin survey as it applies to Asian banks?
I think the most interesting thing was is that Asian banks are concerned about political interference, but are not overly concerned. At the end of the day, the Asian banks came out of this thing pretty well. The regulators haven't shifted that much. Well, in relative terms, they've hardly shifted at all compared to the shifts that have taken place in, for example, the US and the UK in terms of regulatory interference. So I think the Asian banks are in a pretty good place. They're still concerned a bit about political interference, but generally that's a Western or a US type issue that the bankers have.
Some major changes in the survey. Bankers are worried about too much regulation. Surely, after not having been regulated enough, it's a little bit like the pot calling the kettle black.
I think there may be some truth in that. I think the nature is it's not the quantity of regulation that counts, it's the quality of the regulation. So I think there's a concern that if you take the package that, for example, the Basel Committee has come up with, each individual component of it all makes sort of good sense. You add it all together though, and it really could severely restrict the amount of capital that's available in the banking system. And now, people have to remember that doesn't just hurt the banks, that hurts economies. Because the amount of credit that's available in any economy is simply the amount of capital in the banking system multiplied by the amount of leverage the bank's allowed to take.
Chris, can you tell us about the new Basel Committee recommendations for banking and what some of your concerns are about unintended consequences?
That's indeed the case. I mean, if I've sort of seen some worst case projections which indicate that, for example, for the US banking system, if one takes all the Basel proposals and takes a worst case assumptions to where they're going to come out, you would need to virtually double the amount of capital that is already available in the US banking system.
How much is that?
I forget the number I was reading, but it's hundreds of billions of dollars. It's like $400 billion or something.
Add it to Obama's bill. The new Basel things came out on the 17th of December. What are some of the unintended consequences you're talking about if they're implemented?
Okay, I think our main real concerns are on the liquidity side. So one of them is around the ring fencing of liquidity in national markets, which actually isn't in the Basel papers, but it is in what a lot of the national supervisors are doing. Because that could essentially trap liquidity in Asia. Because right now, the surplus liquidity in Asia is used to fund borrowing in the US and in certain Western European economies. Another example is the definition of eligible assets. So, for example, this is just a hypothetical example, but let's say that a Eurozone regulator, let's say one of the more stable Eurozone countries, decides that eligible collateral for the purposes of the liquidity ratios is only its own national government bonds. What would that do to Greece?
Well, no one would want to buy them.
Exactly. And given the problems Greece has got right now, not to mention Ireland and Spain as other Eurozone countries. So the bankers have a lot of concern that if these liquidity rules are defined too narrowly, you could end up causing major disruptions in markets. That's another unintended consequence.
What's the most interesting thing to come out of the banana skin reports from your perspective?
I think what I find most interesting was simply the fact that Asia seems to be so decoupled now from the rest of the world, and decoupled from emerging markets as well. Asia used to be thought of, predominantly a collection of emerging markets with, Japan in the north and Australia in the south, and a few more developed places like Hong Kong and Singapore in between, but predominantly a pool of emerging markets. But if you look at what's coming out of the survey, what the Asia Pac bankers are saying and what the emerging markets are saying, that clearly indicates that there's a big difference now between Asia and the other emerging markets of Latin America and Central Europe.
Thank you very much. For more banking news and videos, visit the Asian Banking and Finance website.